I'm Evan Greenberg. I'm a co-founder of Blockchain Beach, one of Southern California's preeminent blockchain media companies. And I also work on a number of smaller NFT projects as well. Yeah, we're really excited to have you guys here for this sort of investment-focused panel. And I'll sort of let everyone introduce themselves.
Hi, everyone. I'm Patricia. I'm the COO at Nest. We have our own interoperable L1 and built 3 dApps on it, and I'm also a venture partner at a number of funds.
Hey everyone, my name is Felix Hartman. I'm the managing partner of Hartman Capital. Started that about 5 years ago, one of the first crypto hedge funds, and then also last year launched Hartman Metaverse Ventures, one of the, I think, only 3 like metaverse VCs that only focus purely in the metaverse. I think for today's panel, mostly focus on the crypto hedge fund side. And the good news is that even though this year was brutal for everybody, best performing crypto hedge fund in July, best performing crypto hedge fund in October, and second best performing in August. So turns out you can make money shorting Ponzi's.
Good job, apparently. So hi everybody, my name is Dusan Kovacic and I'm the Chief Investment Officer of Rockaway X. We are a venture fund that is in the space since 2017. We invest early stage, mostly C2, Series A, 500K to 5 million ticket sizes. We are historically very strong in infrastructure. I have a computer science background. We have a 30 people team that pretty much focuses on like understanding the tech and really be the extra founder in the business from the technical perspective.
Great. Glad to have you guys all here. Just so we can sort of level set before we get into more detailed questions, you know, we're talking about volatility during a bear market. Where do you think we are in the market right now? Like, what are your sort of just general thoughts on where we're at?
Obviously, it's not a great time in the market, although markets are cyclical. In any market, in any industry, life is cyclical. So, you know, what goes up must come down. What goes up must come down. You know, personally, I think we haven't hit the bottom yet. Again, not financial advice, but that's just my personal sense. Usually as well, within cycles of volatility, that comes a few times. So I think we still have a little bit of time left in this current climate.
I think unless DCG committed any kind of like fraud with GBTC assets, I think we're pretty much peak capitulation at this point. And I do think that unless, again, there is something to the tune of FTX where there was fraud, this is probably the bottom. Because almost every single sign that we saw in 2018, almost every single sign that we saw even in March 2020 is happening. Crypto influencers quitting, you know, companies going insolvent, leverage getting wiped out, both the visible and the invisible. Yeah, I mean, the times when it's the worst is usually also the times when we're getting pretty close.
I would say, I don't think I'm smart enough to assess at what stage market we are at. But I would say like we are in a great stage or a great state of the market as far as the venture investments goes, because the valuations has been decreased since the peak time. Right now there is a room to do real venture investing, like really to build the relationship with the founders and to try and to understand like how we as an investors can contribute to them. And we are seeing pretty much the reduction on the seed round valuation from something crazy like 100 million or like maybe even higher on like pre-product early stage deals into like below 10, 20 million value. Of course, there are still like, there are still over, I would say, quite expensive deals. If you look at the venture funding in 2021 and 2022, combined it was like 50 billion of capital raised in these 2 years into venture funds. So on the Silicon Valley overhyped deals, they are still quite competitive, but generally I see a lot of opportunities in like early stage in founders that have like great background. Maybe they are not like the top of the top, but still can generate like outsized returns. I think that's pretty much our view.
So Felix, you mentioned you're looking at some macro signals, but also you were shorting Ponzi's as a bit more of a micro type of thing. How do you sort of balance the macro and the micro, and you know, with your investing style?
Well, I do think they're the perfect balance because, you know, now that we're getting to this point where, let's say, there's split opinions. Some people think the bottom's in, some people think the worst is yet to come. If that's the case, you know, you want to express somewhat of a neutral stance, right? And like maybe you say, look, maybe Ethereum or Bitcoin, not financial advice. Maybe you say like, okay, they're getting closer to the bottom. But then there's also some things, let's say like an Axie Infinity, like a shitty 2D browser game that's worth $2 billion, where I think most people can agree, maybe that shouldn't be worth $2 billion, right? And so that's how we can balance to saying, okay, look, there's some quality assets that probably will not disappear in 5 years, 3 years, whatever. And there's some things where we can all mutually agree that probably they have another 50, 60, 70% to go down. And so that's, well, like, you know, the way we've shown, like from a trading perspective was really like long short, which usually is hard in crypto because even the dumbest things can rally pretty hard in the bull market. But now bear markets and sideways market is where the market becomes a little bit more honest, where actual fundamentals start mattering again.
Great. And Dusan, you have a computer science background. How does that help or, support your investing?
That's a good question. It really helps ultimately to close the deals fast. Because with the technical background and our background as a positioning as a fund, we are able to build the relationships with the founders as pretty much as fast as possible. I can say, for example, one example that we closed a deal that was focusing on observability as a development tool. And I have been a developer. I was working in C++ like 10 years ago. I don't need to explain what observability is. So as long as I see, okay, the product makes sense, I can assess it very quickly, and the whole fund is optimized for speed and fast decision making. So we are able to establish a really good relationship with the team because we are the thought partner in this discussion. We are not asking what does the tech do, we already know. And if we see that we are happy with the team, we help them and we are able to close deals.
Have you ever passed on a hot deal because just you're like, this tech doesn't make any sense?
Yes, actually a lot. I mean, it happens actually quite often.
Great. Switching gears a little bit, Patricia, you were in the investing world. Now you've moved on a little bit into the building world. What was your reasoning behind that?
Sometimes it's just fun to get stuck in and build your own, as opposed to be more, I guess, what I call on the passive side of the investor. Especially, I unfortunately don't have a technical background, which I wish I did, because I do think in this space, it is really fundamental to be able yourself to do diligence on the technology, right? Coming from a very traditional TradFi background, I used to be in investment banking, M&A, derivatives. Synthetic markets are easy for me. So when I look at just purely on speculation, the crypto markets delinked from the underlying, from the product, from the business, which especially during bull markets happens quite a lot, right? The fundamentals aren't really there. It's far more enjoyable for me to be able to build that whole thing together. So.
And you guys are focusing mainly on sort of digital identity, something that people have been working on for a while. Why do you think it's been sort of slow to come, and what do you think needs to happen for it to really spread?
Yeah, so we focus on digital identity in the sense of real world ownership, applying that to digital assets. And I think with as long as humans are involved, we're never really fully going to get rid of fraud, right? That's down to humans, but we can do everything possible to try and mitigate some of those risks, including real-world identities to digital assets, making it more secure, having various security protocols and identity protocols layered on top will help, especially the non-crypto natives, who are used to living life in this way, having their names attached to their bank accounts and real-world title deeds and things like that, will give them an additional level of comfort. And I think specifically, now with everything that's happened and continues to happen, it's really time to be pushing that narrative of how do we make this space more safe for everyone? How do we try and mitigate even further some of these risks, even if we're not going to be able to get to a point where we mitigate them down to zero?
Cool. And Dusan, I think you've done some stuff with NFTs in the past. Where do you see the NFT market currently?
I actually, initially I was quite skeptical about NFTs. Like when I saw the bubbles, with apes and some other long tail of assets, it was purely speculation. And it is pretty much with every new movement in crypto where speculation is a beachhead market. But if there is a speculation, there is probably something. So for me, I have dug deeper and I have really found the value in, the digital ownership. NFTs are pretty much files you cannot copy. First time in history, you can create a file that you cannot copy, and has a lot of implication on various industries. For example, we particularly recognize three. One is art, especially generative art. It is, now you have this destiny factor when you mint the art piece at one particular moment in time, and it's unique and it stays on the blockchain forever. The second one is gaming. There are two key reasons why NFTs matter for gaming. One, you can build an open economy game that was previously not possible. That creates a lot of like new design spaces. Historically, for example, like I was a long time player of World of Warcraft, and you had like Blizzard controlling the environment. They had all the control, like who can access, how does the economy look like, and you can only like follow the path that they set up. And really, like people are now talking about like the play to earn model, like it was something new, but it really, my friends like 10 years ago were like farming gold in like Shadow Moon Valley, which was like one of the locations there, and selling it and making like $2,000 to $2,000. So it was, it became popular even then, but the problem was like selling assets in these closed ecosystems is against the term of service that put you at the risk of like ban, and that is something that NFTs totally changed. Like with the open economy, you can join anytime. And the third one is the social networks, especially with the recent movements on these Web2 monopolies, like for example Twitter or YouTube or Roblox. They charge incredibly high fees, like 50 to 70% from the creators. And they are pretty much a victim, so they can change the terms anytime. And you probably heard a lot, like on Twitch, there was a streamer, for example, Dr. Disrespect, who made like $4 million per year on the streams, and suddenly he got banned. You know, nobody explains like why he got banned. So you are dependent, your business is dependent on these platforms that can really like terminate your business without like any of your inputs, which blockchain allows to change. So that's pretty much the summary.
I'll jump in real quick too. I think there's a couple of challenges coming up with NFTs. One, just from a liquidity perspective, there's a lot of NFT funds that will need to get liquidated, like Starnet, Capital by 3 Arrows, FTX own a bunch. And so like if you start like unloading a lot of like illiquid assets in an illiquid market, it's not going to go well. Number one. Number two, I think it's similar to like how DeFi peaked in 2020, and then there was a lot that need to get figured out. There's still a lot that needs to get figured out with NFTs. For example, only this year we're starting to challenge the concept of royalties. You know, before it was very clear, the creator always gets royalty. Now there's royalty-free markets, right? And then if there's all of a sudden royalty-free markets, a lot of creators will think twice about like, do I really want to create an NFT, project? And plus, now we're also getting to the phase where people actually need to deliver on those roadmaps. I mean, we created all these roadmaps where it's like, let me sell first and then create something afterwards. And the truth is, nothing is getting created on 90+% of the projects. And so I think there's a little bit more cooling off happening. But of course, NFTs are here to stay. They're here for long term. And then the third part also that's a challenge is that most of the Web2 platforms are putting guards on against NFTs. Even I think Apple put in there that they're saying, hey, we do not allow you to like use NFTs somewhere in there. Steam already did that. I think Epic is the only place that's actually kind of pro crypto, pro NFT. And so like, if somebody wants to launch an app, if somebody or launch a game, and you can't be on Steam, you can't be on Apple, how crucial are NFT? I'm already now seeing startups saying, let me just roll back on NFTs and rather have a market.
Actually, on Apple, the situation is a little bit different. What they did, actually, they updated the policies. You can buy NFTs within the Apple apps, but you have to pay the royalties. And until this case, like these NFTs can unlock functionality in the applications. What is not allowed is like buying the NFTs elsewhere and then bringing it to the Apple app, which unlocks some functionality. The problem with that is like Apple doesn't. But
then you don't have non-transferable NFTs.
That's killing the point. But actually, that's the point. As you are right, but I would say the big companies are not like strictly against NFTs, but that they are like behaving in the like monopolistic way, not to put their like revenue.
Right, it's like that figuring out stage where like then I think long term they will all be on the same page, but like there might be this 1 year period plus, and again that's going to put a damper on the market.
Do you have any thoughts on NFTs?
So we actually have an NFT platform and app. So we went through the whole Apple thing recently. I mean, again, my view on a lot of whether it's NFTs or blockchain is, we're still very early in the space, although we've been around for a few years. And actually, what I would really love to see is some more use cases on NFTs, not just in the same verticals. Again, I mentioned earlier, I have a TradFi background, ex-lawyer. There are so many various utilities for real-world uses of NFTs that just haven't been explored. In my opinion, that's because they aren't as sexy as a PFP picture or being able to use it in the metaverse, right? But there would be some really, really cool trends within NFTs, and I would really love to see, the community explore and drive towards that, as opposed to, again, in bull markets, generally, if something is doing well, everyone tends to, replicate and do the same thing, which also from an investment perspective, to be honest, becomes very, very boring. There was a point last year when I was running the accelerator where I was getting over 100 pitches a day on NFT marketplaces, and they were all exactly the same. There was not a single difference or a single value proposition. Same as with some of the PFP projects. It would be really nice for people to have just that little bit more thought into it of why is this unique, why is it special, how is it going to help onboard the masses, or how is it going to solve a problem that we're still currently facing that we haven't been able to solve.
Yeah, and I think the one thing I'll say about NFTs is that it was the first cycle that we had of NFTs. Bitcoin's had 3-4 cycles. A lot of the cryptocurrencies have had at least 2 cycles, and each time more innovation comes each time. This is the first NFT cycle. What we saw, artists being able to monetize art that was not previously being able to monetize, I think that's great. There is the conversation of how royalties will persist, but at the very least, that initial sale is still meaningful to a lot of artists. Second, these communities like the Bored Apes, like some of these larger projects, they were just companies made out of nothing, more or less. They didn't have to get venture funding. They were able to create a brand and a community, and that was able to fund them into becoming a real company. And now they have to deliver on the roadmaps, as he's mentioned. But it's still really cool that you could basically start from nothing with just a brand and get as far as they did. I think the third thing that's on the horizon that is even happening now in the bear market is a lot of large brands are still looking at NFTs, whether it's building them into their loyalty programs or other ways where people don't even necessarily know that they're buying NFTs or earning NFTs, but it is still giving real world utility for some of their favorite brands. So I personally am excited to see what the second cycle of NFTs is like, in the coming years. But yeah, this is a panel a bit more about, investing through volatility. So, things have not been quite as volatile at different points. We have these things that get these FTX and Luna and some of these black swan events. But when it comes to how you're looking at volatility and risk management over the next year or two, what are you guys sort of looking at?
I mean, the most important thing for people to understand, whether it's retail, institutional, doesn't matter, but 1, leverage, 2, counterparty risk, 3, smart contract risk, all 3 of them, this year, the biggest export to North Korea this year was crypto, because all the bridge hacks, I think over $2 billion in bridge hacks happened. So 1, don't bridge to sketchy other L1s, number 1. Number 2, counterparties. If you don't know where the yield comes from, you're the yield, right? So for example, Celsius, BlockFi, etc. I already talked about this years ago when BlockFi was paying 6% on Bitcoin. Bitcoin does not have staking. Bitcoin doesn't pay yield. So where does the 6% come from, right? And funny enough, guess what? Nexo still pays 10%. So I don't know. Figure that one out. When treasuries pay a lot half of that, and Aave pays 1%. So those 2. So if you don't know the yield, you're the yield. Counterparty risk, that kind of goes hand in hand. Bridges, and then last but not least, leverage. Retail loves leverage, but turns out even institutional. Even 3 hours, even the smartest guys in the room that you thought were the smartest guys in the room were just levered like crazy. And ultimately, that lever always gets punished, and that goes both directions. I think we'll see lever get punished in the opposite direction now, where everybody's short, and we just need a little bit of an up move, and all of a sudden shorts get squeezed everywhere. And we saw this luckily I wasn't short at that time because I made fun of Axie earlier. There was a day in November where Axie went from $6 to $20 in 5 minutes. Why? Because probably somebody got short squeezed, right? So be smart with those things, and you'll actually survive, because ultimately bear markets are a survival game. As long as you stay in the game, you'll win long term.
Yeah, we as a venture fund manage the risk via time, because we spread our investments during the bull market and the bear market, so we average down into the market. And really, we don't use leverage as a venture fund. There is no room for borrowing money. So that's the way how we do it, and probably most of the venture investors do it. What is quite tempting in the bull market, always find some ways how to hack the system and how to make more money than you would otherwise do. So sometimes, the venture funds become a hedge funds and a combination, and then they like lend money from one pocket to the second, and one blows out, and it affects the whole business. And we are seeing it like all over the place now. So the whole point is about like surviving, and I think the most successful investor is the one that survives the longest, and that has always been our thesis on how to manage risk.
On the venture side, what type of companies are you looking for at this point in time?
So we have the two big verticals that we are interested. One is infrastructure, especially the one that utilizes zero-knowledge technology, because we see the next generation of blockchains is coming from this direction. Like now the blockchain works. Okay, there is a transaction, it gets replayed on these 1,000 nodes, they produce the similar result, they compare, it settles. While in the new generation where we have the blockchain scalable with zero knowledge proofs, there is only one party doing a computation, and to the result it attaches a cryptographic proof that they haven't cheated. And the other parties, the other nodes, they don't have to replay the computation, they just verify whether the result matches the cryptographic proof. So that's like one angle, seed to Series A, sometimes Series B. Ideally, we want to lead the rounds. So that's like one big angle, and second big angle is consumer. We see the next wave of crypto adoption is coming from the consumer applications, especially the social networks and gaming. So we are happy to lead deals as well. We find a good synergy between the game and entertainment companies that are coming into the space with our tech background, because they typically are not really well suited to understand like the pros and cons on like all these blockchain infrastructure projects. So that's our angle. How do we make the deals in this area as well?
And you mentioned zero knowledge proofs. For those of you that aren't quite as familiar, it's a technology that's been worked on for the last couple of years, but is seen as one of the major ones moving forward. Basically, in layman's terms, like when you go to a bar and show your ID, you're doing it so you can prove you're over 21, but you're giving them your picture, you're giving your address, you're giving all kinds of information they don't actually need to know that you can go into that bar. So what zero knowledge technology does is it allows the person who's checking your age in this standpoint to know that yes, you are over 21, but to not reveal a bunch of other information that they don't actually need to know. So it's a pretty cool technology. You guys are using it in your platform, correct?
We do quite a lot. Yeah.
You want to talk about that a little bit?
So it's really reiterating what you said. I mean, we use it specifically for what we call the SSD ID and any type of logins. For us, all of the data is device-side encrypted, double encrypted, and then splintered across our own chain. So this is where I go back to, one of the things that we focus on quite largely at Nest is how to increase security measures for the average person to give them the same comfort that they would have in the traditional finance sense of owning their assets. But yeah, it is a big one in the industry at the moment. So
cool. And if anyone from the crowd does have any questions, feel free to raise your hand and we can get to that. But basically, how are you guys looking at regulation? I feel like there's some regulation coming from the United States probably on the way. What would you want to see? What are you expecting? Any thoughts there?
So I was in the regulated space for many years as a lawyer in banking, so I probably have a lot to say which will bore every single person here. I personally don't believe, and I've seen this in TradFi, that regulation is going to solve all our issues. It can't, because again, we go back to human behavior. There is nothing in the world that is going to make someone not act in a bad way. So yes, we can put all the bells and whistles on, around it. But really, same as with FTX, if they had been, fully regulated, and they were regulated in some places, wouldn't have really stopped the actual fraud of happening. Similarly, it doesn't stop it happening in the banks. So, but I do think, regulators have been wanting to, or looking for a reason to come in. They're going to come in pretty heavy-handed. That's usually for the US as well. Once that happens, it's kind of dominoes, and it will happen across the world. But I think it will be very difficult. We saw this in 2009 in TradFi markets with derivatives, and it really strangled the market for a significant amount of time. So I'm kind of bracing myself a little on that.
I mean, I think ironically, the solution, I think, is actually less regulation. And the reason for that is that because we had so much regulation domestically, it pushed all the actors offshore, right? The reason every crypto fund was on FTX and Binance is because Coinbase, they don't even have margin. They have virtually no products. Why? Because it's forbidden, right? And so they've been doing is punish the good actors. They've been punishing actors like Coinbase and Kraken who act by the rules. They're domestic. Kraken even has a bank charter. But then, because clearly you can't do your full business there, you have to go to, for example, Binance. And now Binance is in good lights, but it's also worth noting that Binance had a lot of sketchy shit happen too, right? Or for example, you had Brian Brooks, the former control of the currency, last 3 months. Catherine Cooley lasted a month, right? These are 2 former Binance US presidents, and those are red flags, right? So it's that doesn't happen unless there's something bad happening underneath the hood either, right? And so it's now we're stuck with 70% of volume being on Binance, which is not a solution either. So yeah, I think ultimately we need to get to a point where we can operate crypto from the US domestically, and where we're also not literally, banning U.S. Investors from partaking in a lot of these opportunities, just because, whether it's because of accreditation rules or even just in general. So many times you go to a platform that says you can operate here unless you're from Somalia, North Korea, or United States, which is a weird group to be in.
So as for us, we are part of Blockchain for Europe Association. We are not directly exposed to the US regulatory environment. We mostly focus on the European one. There are new, there are key, I would say, initiatives. One is MiCA, the second one is TFR. It's pretty much there to put order into issuing tokens, issuing stable coins. We don't find it particularly, I would say, putting the crypto businesses at risk, but it will definitely increase the capex and the barrier to entry for new entrants, especially on these on-ramp and financial products that connect the traditional world with the real world. With the crypto world.
Cool. And then another one of the sort of hot terms of this last cycle was metaverse, and cryptocurrencies and NFTs being part of those. Do you guys think there's anything to the metaverse, or is it pretty far off?
Careful, I'm on a 30-minute rant. I do run a metaverse fund, so. So since I've been ranting about the liquid side, I do run a metaverse VC, and so to me the metaverse is the digitally native world. We're already now spending more than half our waking hours in the digital world. To me, stuff like social media, gaming, TV, and so forth, that's metaverse 1.0, except 2.0 now is 1, decentralized, 2, you do have self-sovereign ownership, where the things you own in the metaverse, the things you think you own in the metaverse, you actually do own, right? You can transfer it and so forth. I think it is going to be the biggest trend for the next 5 to 10 years, hands down. I do believe also that VR is going to play a way bigger role than most people give it credit for. Form factors are improving. Sales numbers are going through the roof. The last 4 years, the amount of headsets has been doubling year over year. And that's just not a trend you turn the clock back on, especially because every single big tech company is getting behind it now too, from Meta to Apple to Sony's doing the PSVR 2, ByteDance, and so forth. So I think the metaverse is here to stay. It was surely a hype last year, but just like crypto was a hype in 2017, one that will persist.
I think metaverse is actually quite interesting. It's an amazing opportunity, but I think it will be somewhere else than what most people think. I think the main definition is it's a 3D world, like an immersive. But if you think about it, you will not make money, or the biggest markets are not selling VR or AR headsets to consumers. Even though this will be probably a big market, 100 billion, maybe 200 in 5 to 10 years from now. But it's all about these open economies that are interconnected, which is, in my view, what metaverse will become. And the user interface layer, maybe AR, maybe VR, maybe it will be mobile, who knows. But I think the ultimate main upside is in these creator economies, because what really these open economies allow is the creator economy leverage. Right now in Web2, you have the creator economy on these platforms like Roblox or YouTube, where, as I mentioned earlier, these giants charge 50 to 70% of revenue. In crypto, it's very much different. OpenSea charges 2.5%. And this is ultimately going to result in these open economies that will be interconnected and generating, I would say, really larger revenue what we see now.
Cool. Well, we sort of come to the end of the panel. So just any last thoughts from anyone?
Just survive.
Good luck.
Good luck, survive, and welcome to Dcentral Con.
Woo. Yeah, things will get better, guys. Heads up. Bull market soon.
Thank you.
Thank you.